Good morning, everyone. Welcome to today's lecture. Today's lecture will begin the first lecture on a series of discussion on financial reporting and analysis topics for CFA Level 2. Before we dive into this section, I wanted to emphasize that the FRA section has a really heavy weight on the CFA Level 2 exams. The FRA section weighs about 10 to 15% out of the 100% of the exam, meaning that there will be around 2 to 3 minutes out of the 21 minutes that will show up on the exam. So the FRA topics will be very important in your study. And in the future lectures, we'll be covering all of the readings in this section. As we can see as an overview here right now, readings from 13 to 15 will cover 3 different topics of FRA. These are really technical and core accounting concepts. We'll be discussing inter-corporate investments, employee compensations, as well as multinational operations. And then later on, from reading 16 to 18, we'll be discussing some of the more softer topics, such as the analysis of financial institutions, evaluating different qualities of financial reports, as well as the integration of financial statements analysis techniques. So without further ado, let's dive into today's topic. Reading number 13, inter-corporate investments. When we talk about different investments in different companies, there are definitely different range of investments, from a really passive investments where you only hold shares of a certain company to really active investments. For example, you purchase a business and you acquire the business to have it integrated into your day-to-day operation. And obviously the accounting treatment for these all different types of investments will be significantly different. In today's lecture, we'll be discussing how to account for these different types of investments in our financial statements. So when we talk about different accounting treatment, from this chart, we can see there are obviously different types of investments, as I mentioned. There is the investment in financial assets, investment in associate or joint ventures, as well as the investments in business combination. And how do we determine which one is the investments that we're currently holding? I guess the number one evidence is the quantitative evidence that we're looking for. And then in terms of typical percentage interest, in terms of the quantitative evidence, we're looking at less than 20% of ownership, or 20 to 50% of ownership, or more than 50% of ownership. And based on the ownership, we can evaluate what type of investments that we're looking at, and then develop the accounting treatment to treat for these accounting investments. So for example, if we are having less than 20% of ownership, then we'll account for these investments as investment in financial assets. Or if we have more than 50% of ownership, then we obviously need to account for these investments using the consolidation method. So remember that the number one evidence that we're looking for in determining the ownership is the quantitative evidence that we're looking for in terms of ownership. And then usually in the exam, they will give you a percentage of ownership in this business. And then that's the number one clue that we're looking for in determining which method that we'll be using in our accounting treatment. And number two clue is the qualitative evidence that we're looking for. In terms of qualitative evidence, we're looking for any type of influences in terms of board presentation or any control in the day-to-day operation of our investees. So in terms of investments in financial assets, obviously we don't have any ownership, and we are not involved in the day-to-day operation. In terms of the influence, we don't have a significant influence. And one example of this is that, for example, I'm a company A, and then I only hold shares in Microsoft. Say that I only hold 1% of shares in Microsoft. It is very unlikely that I will have influence over the day-to-day operation of Microsoft. I only hold these shares to take advantage of the increased share price, and then I can realize the gains over the period. So because my investment is very passive, this is called investment in financial assets. And then in terms of investment in financial assets, then we will use the accounting treatment through three different methods: fair value through profit or loss, fair value through OCI, or amortized cost, which is only for debt instruments. And in the later sections or lectures, then we'll be discussing the specific treatment under each accounting classifications. And moving on, what if we have an ownership in another business ranging from 20% to 50%? Then the number two qualitative factors that we're looking for is how much influence that we have in a day-to-day operation. In terms of in associate and joint ventures, it is typical that we and another company, we formally together own the operation of a third company. We together jointly owned and operated the business. We both have control, and then we both are involved into day-to-day operations. So this is the number two clue that we're looking into in determining what kind of investments that we have. So to emphasize, if we and another company jointly own a third company, this is called a joint venture. And then because we are involved into the day-to-day operations, then it's said that we have significant influence over the operation of the business. And then in terms of in joint venture and associate, then we'll be accounting these investments using the equity method under US GAAP and IFRS. And in the later sections, we'll be discussing what it means by the equity method and how specifically we'll be recording these investments in our income statements as well as our balance sheet. And moving on, what if we have control over another business? Say that we acquire another business, and then in terms of we acquire another business for different purposes or different reasons. For example, company A may want to acquire another company to realize some synergies in their operation in terms of cutting costs or taking advantage of their expertise in senior management. If we have control over another business, this is called a business combination. And then obviously, in terms of business competition, we are looking at really active investments because we are involved into day-to-day operation of another business. And in this situation, we'll be accounting these investments using the consolidation method by bringing all the assets and liabilities of our investees onto our balance sheet and income statements. And in the later lectures, we'll be discussing what are the transactions and how do we account for a business combination transaction on our financial statements, as well as what is the impact to our balance sheet, what is the impact to our income statement by using the consolidation method. And before we go into specific sections, I wanted to emphasize what typical questions that you'll be seeing on the CFA Level 2 exam in the FRA section. In the FRA section on the exam, you typically see a paragraph, discussing the transaction and then the type of investments a company holds in another business. They will give you, for example, a quantitative evidence you own a certain percentage of ownership, as well as qualitative evidence, for example, how much is the control that you have, how much is the influence that you have on another business. And the question they may ask is, what type of investment is this? and then you will have to determine whether it's investments in joint venture, investments in business combination, or investments in financial assets. And then after you determine the type of investments, they will ask you how to account for these investments and what is the impact on their on the income statements, what's the impact on balance sheet, as well what is the impact on our current ratio and different type of ratio analysis. So in the lectures later on, we'll be discussing the different treatment under different type of investments, ranging from really passive to really active.